The other day, I asked all of you if you were bullish or bearish for the rest of 2021. And the reason why I asked that was because July starts the second half of this year, and I was interested to see how all of you feel for the remaining 6 months of this year. And most of you said that you were bullish, a few of you said you were bearish, and that's totally fine. But what I wanted to do today is share with all of you my investing strategy for these next few months, talk about an ETF that I'm going to be adding to my portfolio, as well as some things that I'll be watching out for the rest of this year. Hey everyone, thanks for joining me today. My name's Matt, and as always, before we get started, I just need to say, not advice, don't take it as advice. If you need advice, speak to an advisor. This is just for entertainment purposes only, so do not make any decisions based on what I have to say here. Also remember, like, comment, subscribe, all of that fun stuff. I really just wanted to go ahead and get into this video today because I think it might be a little bit of a long one. So I wanted to start off this video here by talking about my strategy looking at the next 6 months. And when I look at that time frame, it doesn't have a huge influence on my investing strategy because I am a long-term investor, but there could be some changes that I'll make along the way. And with this Watch This Wednesday portfolio just being a simulated portfolio and not my real money, I don't have a specific savings objective that I'm using this for like I do with my own personal accounts. So I tend to just set this with a 5-year time horizon with all of these investments and kind of just leave it at that, but again, with no real specific objective. But that being said, if I were to treat this like I would with my own personal money, then I would look at my 5-year time horizon that I have for that specific savings objective, and I like to look at it as a road trip. Of course, you're going to have to plan stops along the way because that is a long road ahead of us, and maybe those stops we could look at as 6-month to a year intervals to help us get to that destination. Again, I do believe investing for the long term, but I think it's important to have a strategy along the way and help you achieve your investing goal or give you the best possibility for success. So while yes, we say 5 years, that doesn't mean I buy it today and just forget about it for 5 years. I still want to make sure I have a strong and sound objective along the way to help me achieve that goal or give me the best chances of success. When I look at the next 5 years, it's pretty easy for me to remain optimistic about my investments that I have because I do believe in a lot of the investments I have in this portfolio. Not all of them, there's a few exceptions like Tesla and Coinbase, but for the most part, I believe I invest in companies that I could see easily being around in the next 5, 10, 20 years that are financially strong investments, whether they have strong balance sheets, they have a low valuation, or they are continuing to grow in a market that could be brand new. When I shrink that time horizon down though from 5 years to 6 months, while I still remain bullish, I am not as optimistic, and that level of bullishness does tend to decrease. But how will that actually influence my investing strategy? Well, let's go ahead and talk about that. So to start, when I'm not as optimistic about the future, thinking that, stock market's just going to continue to go up like everybody's been saying, I tend to put a lot more emphasis on my strategy of buying in thirds. Again, if you haven't heard me talk about that before, I guess it's been a while since I've mentioned that. When I see an investment I like, but I'm not sure if it's the best opportunity to buy right now, I like to take my total investment and break it down into 3 payments. This way, I don't go into a position with everything all at once, and in case a better buying opportunity comes along the way, I'll have that cash ready on the side for us to be able to go ahead and get into it again at that better buying opportunity. And this is something, admittedly, I probably should do more often than I do, but especially in times like this, where there isn't, again, as clear of a future for what the stock market will look like, then I think it's always important to just make sure you have some cash on the side, whether that be for emergency savings money or just for a better buying opportunity in case the stock market does take a hit and you could be getting the stocks at a discount. I also start to take a step back from companies that I believe are more speculative investments. Again, this would be companies like Tesla and Coinbase, and I might even consider throwing Jumia into that mix just because we're not as sure as what that future could look like for those companies. And they tend to be ones that do face a lot of volatility, which is not really something I want to incorporate into my portfolio when I don't always have the most bullish outlook for what that future could be. Lastly, probably the biggest change that I see with my investing strategy as I look forward, for these next 6 months, is I do tend to start favoring ETFs more often. And that's what I wanted to talk about now. Now, I know when it comes to ETFs, I do tend to be a little biased considering that I used to work for Vanguard and ETFs are actually what kicked off my investing interest. But I really do still love ETFs, and I still believe that a lot of people should be investing in ETFs rather than trying to pick out individual stocks, or at least a lot more people should just be investing in ETFs than trying to tackle the process of buying your own individual stocks. Now, the reason why I'm buying an ETF this week is a lot different than the reason why I bought VOO in the portfolio. So I also wanted to show you another strategy for investing in ETFs. If you saw my video on why I added VOO to the portfolio, it was because I wanted to create what we call a satellite portfolio, or essentially using a 500 index as an anchor to my portfolio to help offset some of the negative returns that we might have from a more speculative or risky investment. But that's not what we're doing this week with VTI. Now, VTI is another ETF that I have already done a review on for my channel, I guess around a year ago. But the reason why I'm adding VTI to the portfolio this week is because I was still in the process of reviewing some of the stocks that I've already talked about on my channel to see if a buying opportunity is still there and if there's any positions that we could double down on, while also looking at some other companies. And I realized that these all fell into a technology sector. Just to name a few, so you're familiar with some of the companies I'm talking about and why this one stands out to me, is I was looking at adding more shares of DocuSign, a few more shares of Zoom, and then I was considering adding some new companies like Zynga, the app maker, or even ZipRecruiter to the portfolio. But I wasn't sure, how did I want to weight these? How much additional did I want to get? All that fun stuff. And an ETF at that point for me just made the most sense because I can get all of those companies by buying one ETF, and I don't have to worry about how I'm going to weight those, how much investment they each deserve. I just went ahead and put in a fairly large amount into one ETF, and then that way I have exposure to all of those companies and then some. Now, this wouldn't be a Watch This Wednesday if I didn't have some numbers to review, so I will quickly go through some numbers here for VTI. As always, one of the most important things to look at when you're looking at ETFs so you don't see with stocks is the expense ratio. Obviously, for this one being at 0.03%, it is very low, staying true to the Vanguard tradition, so I am okay with the very low expense ratio. Again, that is literally less than pennies on the dollar that we'd be spending to invest in this, so really no problem there for me from an expense cost. This ETF also has $233.4 billion with assets under management, so that's the amount of money that is invested inside of this ETF, and that is larger than the market cap of a lot of companies we've been looking at recently. So this is obviously a very large fund, which is a good thing to see because when funds are too small, then liquidity could become a factor. There's a few other issues that you want to take into consideration. I've covered all that in my ETF video, but $233 billion, we don't really have to worry about liquidity with this ETF. Now, this does pay a dividend of 1.25%, which isn't too bad. Now, I'm not investing in this for the dividend. I am investing in this for the growth factor of it that I think a lot of technology companies can provide, but nonetheless, it is a nice little added bonus to have that 1.25% dividend yield, especially if you are a dividend investor. I also love this ETF because it does have a low turnover ratio of 8%. Remember, turnover ratio is the amount of positions that are bought and sold, I believe, within a year's time frame. It's been so long since I've talked about it, I forget, but I'm pretty sure it's within a year's time frame of how many positions are bought and sold. And obviously, again, being a long-term investor, I like to make sure that number is on the low side. Generally below 12% is okay with me. Sometimes I can go a little bit higher depending on what the returns look like. But it's just good to find an ETF that matches your investing strategy. If you're a relatively short-term investor, then you can find ETFs with a higher turnover ratio, but generally what you'll see with that is a higher expense ratio given how active the managers have to be with that ETF. This ETF also gives us exposure to 3,792 different stocks. I think there's a few bonds and some cash in there as well, so it's not entirely all stocks, but that is a lot of companies, and I can't even imagine how many Watch This Wednesdays I'd have to do to be able to cover all of those different positions. So by buying this one ETF, I of course get exposure to the companies I want, maybe a few that I wouldn't necessarily personally invest in, but hey, those can help us in performance, so I'm never really going to complain about a broadly diversified fund. And lastly, a very surprising beta of 1.01, so basically what the market does. So I personally will be interested to see how well this performs compared to the VOO we have in here. I personally would have thought that it would be a little bit more volatile than what the market has, but nonetheless kind of makes sense when you have that many positions to perform very similarly to what the market does. One thing I do talk about a lot when it comes to investing in ETFs is to make sure you avoid what I call overlap between investments. And the simplest way I can explain that if you're new here is if you go to buy a 500 index, you don't need to purchase Vanguard's, Fidelity's, and Schwab's 500 index because those are ultimately going to be almost mirror images of each other. And they're going to have a lot of the same investments. You can if you want to, but don't let that fool you for diversification because ultimately the stocks inside of that ETF are going to be the same. Now, when it comes to owning VTI and VOO, are we going to have an overlap with those investments? And the answer is yes, absolutely we're going to have some overlap with it, but not all of the funds inside or not all of the positions inside of the ETF are the same, like it would be if we bought a Fidelity Technology Index fund. So with this, I'm not concerned with the overlap in investments because some of the positions that we are getting double exposure to, in some cases even triple exposure to, are companies that I'm okay with having a larger position in. This would be companies like Apple, Microsoft, and Facebook. So with this position, you don't, or when it comes to owning something like a technology index versus a 500 index, the overlap isn't something you have to take into consideration as much. And taking a look here at the portfolio just to see what we have in here, since I've been sitting here filming this video, we've lost $2,000, so it must be a pretty rough day in the market. We see VTI down here, so we're down about $63, which is fine. I own about 50 shares of it, and I purchased it at $225.14, basically $225.14, and which is a lot. It gave us over $11,000 of exposure, which is double what I typically do with investments. But again, I wanted to add a lot of the positions inside of VTI to the portfolio, and if I were to try to buy, just list the ones from earlier, which were, Zynga, Zoom, DocuSign, and ZipRecruiter, then keeping my $5,000 investment true, that would cost me $20,000. So instead, I spent half of that, put it into an ETF. I got exposure to all of those companies and then some, which I think is a pretty good trade-off. We'll just have to see if this actually plays out well for us, which I do think it will. Anyway, just a few highlights here in the portfolio. So Blackstone and Shopify is still doing great. Microsoft is also doing very well. And Tesla is on its way back down dramatically again. So that one, I'll be honest, I can't wait to get it out of the portfolio. Again, being a long-term investor, it feels very weird saying that, but it's just been nothing but a drag on the performance of this portfolio. So I am very eager for that one to get up at least close to the green so we can exit that position and buy something a little bit smarter with the money. Now lastly, to wrap up this video here, I wanted to talk about what am I going to look out for the next 6 months. And again, these are things that I'll watch for because I think it's important to understand how it could impact companies. But it's not necessarily going to be something I put too much emphasis on because when you're investing for, let's call it 10 years to be safe, if you have a 10-year time horizon, you're going to see multiple different presidents in office, at least two. So you're not really, so when you hear things of like policy changes, tax rules, all of that, when you have multiple changes, it's not going to make a huge difference on the performance of your portfolio, but it will say a lot about the companies you invest in because you should be investing in companies that can do well regardless of who's in office. That said, some things I'm paying attention to finally. First one is going to be inflation. Now, yes, very contradicting to what I just said, but the reason why I'd pay attention to inflation is because if the cost of goods or if the cost of goods sold starts to increase, then companies' performances might not look as great because it's going to be more expensive for them to produce those products. The other alternative to that is that they have to increase the price of their products, which could mean that they'll have a decrease in the amount of sales or units sold over the next quarter to year or so. So again, taking a look at like a company like Apple, I'm not that concerned about it, but when I hear the earnings reports and when I read the headlines saying, Apple sales are down or Apple's earnings dramatically down, that might not be something that Apple is doing specifically. Rather, it's just a result of the current environment that they're in, and they're going to work out a way to overcome that challenge. So that's where I do like to pay attention to inflation, just to make sure when I see those crazy headlines with very bold statements that I don't really fall into a media trap of it, and I actually understand why the company's results are not looking as great as they were a year ago. Also, again, to contradict myself, there's the whole Biden infrastructure plan. I'm not going to talk about that here because I really just do not like talking about politics. But it is something that will be interesting to see how it all plays out. And again, what businesses or corporations are able to benefit from this, as well as the habits that we see in consumer spending. So that's another thing just to keep an eye on. And lastly, this is probably going to be a very hot take, so bear with me here. But if I were to speculate that the market is going to go down, I will be very curious to see what's going to happen with like the YouTube and TikTok stock channels. Of course, I'll still be making videos. I know a few other people out there will be as well. But right now, to me, it just seems like a lot of channels are all hype. And if that's what you find entertaining, that's totally fine. But I'll be just very curious to see what's going to happen if the stock market does go down for a few consecutive weeks or so. Are people still going to be posting those videos saying, you know, four stocks guaranteed to boom today? This stock will make you rich in the next 3 months. Or having people like Meet Kevin saying that the stock market is rigged because he bought a $20,000 a year service from Bloomberg. I don't know. And obviously, I feel very strongly about me, Kevin's opinions on the stock market. I'm not really going to share with you my thoughts here unless you ask, and then I gladly will. But I'll say, watch his videos for entertainment, not for any kind of investing decision. And I actually do think that if we were to have a correction, and a lot of these, you know, what do they call themselves? Tick stocker? That sounds weird. Stock tick? Tick stock? I don't know. Whatever they call themselves. Or finfluencers. Anyway, I'm done trying to figure out what they call themselves. I will just be curious to see, you know, when things are down, do they still have an investing strategy in place? Again, I'll still be here. I know a few other YouTube channels will definitely be out here as well, because that's when investing really shines, is how well can you do during downtimes, not when everything's green and you could really just throw your money at something and expect it'll double in the next 2 weeks. So those are my kind of things I'll be watching out for. Again, 6 months is a little short to really see any of that come to fruition, but it is important to keep an eye on your portfolio and make sure you don't lose track of your objective goal. So with all that said, I hope you enjoyed this video. If you did, leave a comment below letting me know what you'd like for me to talk about. That's not the correct order. If you did, I hope that you liked this video. And if you haven't subscribed already, I just ask that you consider doing so. I cannot talk today. This video has been a struggle to do. So I'm just going to wrap up here. Leave a comment below if you have any questions for me. As always, please feel free to comment on my social posts. I don't know what that is exactly called either on YouTube, but I really love engaging with all of you and would love to hear your thoughts for the next 6 months, if anything's changing with your strategy or what else you might be taking into consideration when you look forward with the stock market. So leave that down below. I'm going to wrap up here though, so thank you so much for taking the time out of your day to watch this. You could be anywhere in the world, but you're right here with me, and I really appreciate that. But I'll let you go ahead, enjoy the rest of your day, and I will see you next time.